Mansa-X delivered a return of 14.96% after fees in Q3 of 2021, and this brings the performance of the fund to 14.05% after fees year to date. So the first 9 months of the year, the fund has delivered 14.05% after fees, which is around 19.05% before we take out our fees. Last year, around this time, so the first 9 months of 2020, the fund had delivered around 18% after fees, and this was slightly higher than this year, and there's a reason for this. So towards the tail end of Q2 2020, this was around the time there were expectations of the reopening of economies around the world after COVID. So that optimism definitely buoyed markets in the Q3 of 2020 compared to this year where the narrative has shifted. So towards the tail end of Q3, we saw concerns around inflation, and this is really has been the conversation this year. Conversations around the Federal Reserve, for example, tapering the stimulus that we saw last year. So this obviously has kept markets a little bit more subdued than last year, hence the difference in performance. Q3 of 2021 was a very interesting quarter, mostly because the first 2 months, the global stock markets, especially in the US, was still very interesting. We had a more than 5% gain in the US stock markets, which we were very heavily involved in the first 2 months of the quarter. So we were able to squeeze out returns from that market at that time. But towards the end of Q3, we started seeing, talks about tapering and inflation concerns, and we were able to exit a lot of our positions in anticipation of a lower market, which is exactly what happened in September. So we lost some of our gains made in the first 2 months, but not everything in entirety. But we were able to also now go into other asset classes like commodities. So we started seeing a big rally in commodities in September. For example, oil jumped 2% in the last quarter, and a big part of this move was actually done in the last month of Q3. So these are some of the asset classes that we were able to take advantage of. We were also able to heavily invest in dollar-denominated assets, which helped us to grow the fund because the dollar really strengthened in Q3. And this also relates even just to the nature of the fund, because the fund has a lot of dollar assets, and if the shilling is weakening against the dollar, for example, this quarter, the shilling weakened about 2% against the dollar. This helps to push up the returns of the fund because the fund gives out the returns in Kenyan shillings. So this again goes to prove our concept and the trading model of the fund, that because we invest in so many asset classes, we are able to shift and adjust our portfolio to take advantage of this diversification and to also protect against downside risk. Because if you look at any other fund manager who would probably have only had, say, equities as the only assets that they invested in, would have really struggled to give any return in Q3, and in fact would probably have ended up with a negative return because of the wipeout that we saw at the tail end of Q3. So we are still very confident about the trading model and the fact that it was still able to squeeze out a return in a very volatile quarter for the markets. So the best performing assets for Mansa-X in Q3, number one, global stocks, specifically the US stocks. We saw a very nice rally in the first 2 months of the quarter. We are very happy that we were very concentrated in high dividend yielding stocks. So this has continued to be a very nice model for us because we continue to receive more than 4 to 5% dividend yield from most of these stocks. And this therefore really boosted our returns. We were also able to squeeze out very good returns from oil prices at the tail end of Q3. And we were also heavily invested in the dollar itself against various against various currencies, the euro, the pound, especially the pound, because we noticed in Q3 that the pound was really beaten because of what we are seeing with Brexit and concerns around supply, the supply chain in Britain right now. So that has really weighed down on the pound, and we were able to squeeze out a very nice return by shorting the pound against the dollar during that period. So those were the major asset classes that we made a return out of in Q3. Of course, one of the most disappointing one for us was gold, which remained relatively flat during that period, but we still continue to hold gold in our portfolio. Q4 of 2021 I expect this to be a very interesting quarter, especially in regards to yields. We are very keen and will be observing how the US Treasury yields behave, especially the 10-year yields. Right now they are trading at 1.63%. That's relatively high compared to the fact that if you consider that in August the yields were as low as 1.09. So that's a very big jump in US Treasury yields at a time when inflation in the US has already jumped again to 5.3%. Now this might take away capital from the stock markets towards the higher yielding US Treasury yields, especially because the average dividend yield for the US stock market at the moment is 1.3%. So there's a big concern that the correction that we are seeing in the markets right now might continue. And the stocks that will be most adversely affected will be technology stocks. So we are considering shorting some of these stocks. So that's a strategy that we will be looking at and in how we rebalance our portfolio for this quarter. We will continue we'll still continue looking at dividend yielding stocks as well, and utility stocks that are not so sensitive to inflation rises. So for example, Duke Energy and Excel and COP. So we'll be looking at such stocks in Q4. So another thing we'll be looking at, if markets are falling, safe haven currencies also tend to benefit. So we'll be looking at buying safe haven currencies like the Japanese yen or the Swiss franc, and obviously the dollar for that period of time, and also monitoring the effect of commodity prices and seeing whether we can benefit from rising commodity prices in commodities like oil, for example. It's also very important to note that during this period, consumer staples companies might actually really suffer because their margins will most likely be squeezed during this period because of rising inflation and rising cost of inputs. So it will be very interesting to see whether we can get some stocks again within those sectors that can be shorted for some sizable gains. So that's what we'll be looking at in Q4, and we expect that it should be very interesting to see how a rebalanced portfolio will perform in those kind of circumstances. So in Q4 of 2021, investors should expect a market very different from how it was last year. So they might see fall in stock prices, for example, and they might see much higher commodity prices. They might see higher yields. They might see tech stocks underperforming. They might actually see some dividend yields dropping with certain companies. But that is not necessarily a bad thing. The way Mansa-X is designed is such that we are still able to take advantage of falling markets. It's one of the biggest advantages of this fund, meaning that if markets are losing value, we can still make money by using something called shorting. We can short markets and still make a return out of markets that are losing value. And this is something that we have always said is one of the biggest advantages of this fund. Again, the fact that we're able to really diversify the fund means that there are very many opportunities that we can take advantage of. If, for example, oil prices are rising, we are still able to buy oil contracts and then short certain US stocks, for example, or we are able to buy the Canadian dollar as a proxy for rising oil prices. So this diversification in our portfolio gives us confidence that no matter how volatile Q4 is, we should still be able to squeeze a reasonable return for our investors. Of course, right now, a big part of our focus is really just protecting investors from downside risk. It's very important right now that we do not take disproportionate risks with our investors' money, but we are still able to squeeze a return based on the diversification that we have, and we'll continue using our trading model, which has been proven in the past to be effective to squeeze a return that's above average for our investors.